Welcome everyone to this latest session of the Association for Heterodox Economics 22nd annual conference, but first online conference. So we're all enjoying this different environment. Welcome, very pleased to have you here. This session is on macroeconomics and finance. We've got three speakers that I'll introduce shortly. Each one will speak for 20 minutes and then we'll have plenty of time at the end for questions and answers. We will finish the session at 5 o'clock. Okay, the session is recorded, so just be aware of that. Your faces, if you're a participant, your faces and voices won't be recorded. Any questions you put in the box, the Q&A box will be, so just be aware of that. Let me just point you towards that. At the bottom of your screen, there will be two boxes, a Q&A box and a chat box. The chat box is just for any kind of technical issues. So if your reception is poor or if you can't really hear one of the speakers very well, you can let the technical support Anders know and he will see if he can help you. The Q&A box is, as it suggests, for any questions and answers to the panelists. And you can post as many questions in there as you like. You can also, I think, upvote questions that you think are really good of other people. The panelists can respond to those either live on screen or they can reply to you in text. It'll be up to them, but hopefully they'll keep a few questions back for the discussion towards the end. Okay. If you are a Twitter user, then this conference has a hashtag, which is hashtag AHE2020. I'm not very imaginative, but there you go. So hashtag AHE2020. So as I said, chat box for technical issues, Q&A for any questions to panelists, 20 minutes per panelist, and let's get started. And the first panelist is from University of Massachusetts, and it's Devika Dutt. And so let's. Okay, is that okay, Devika?
Yeah, looks great.
Okay, over to you.
All right. Thank you very much for coming to my presentation and for the organizers of the Association for Heterodox Economics Conference. I'm very sad we could not all meet in person. I think it would have been really amazing, but sign of the times, I guess. All right. So my name is Devika. I am a Devika. I'm a PhD candidate in economics at the University of Massachusetts in Amherst, and I'm presenting to you basically the last part of my dissertation research, and I have to apologize because it's hot off the press, like not even off the press, still on the press, so it's very new, and therefore there's a lot of, I've never presented this before, and therefore there's a lot of information that might be a little bit scattered, so please bear with me. And yeah, please feel free to ask questions or ask for the paper, because there's a lot in the paper that I could not coherently put in the presentation. So yeah, please feel free to ask any questions. All right, the topic of my presentation, as you can see, it's about the role of the US dollar, its exorbitant privilege or ultimate responsibility, access to the international and last resort, and I take this exorbitant privilege, as you may all know, is reference to, I think it's made famous or coined by Barry Eichengreen or made famous by Barry Eichengreen, I'm not entirely certain, which refers to the unique position of the US dollar and the benefits that it accords the United States economy, given that it is the global reserve currency. I argue that, of course, there's no contesting that fact, but of course it imposes a responsibility on US institutions such as the Federal Reserve and the US Treasury that in order to stabilize the global financial system, but whether it does it or doesn't, it's a whole other matter. So yeah, I'm going to explore the factors which determine whether you get access to the international lender of last resort institutions, which I will define clearly. Yeah, and basically I'll go we'll just get to it. Yeah. Next slide, please. So as we all know, this is a very famous quote from the former ECB president, Mario Draghi, who said in July 2012, in the midst of the financial crisis that was taking place in Europe at the time. There's so many crises, I feel like we really have to date them. Not even generations can identify. But as we all know, he said that within our mandate, the ECB is ready to do whatever it takes to preserve the euro, and believe me, it will be enough. We do know that it was enough, that immediately after this announcement, regardless of like any measures before, I mean, of course, the ECB had taken several measures to stabilize the European financial markets, but this very statement had like wide-reaching impacts on stabilizing the financial system without actually the ECB having taken any action. However, as also a lot of us might know by now, because it's very well documented, that before this and after this, the Federal Reserve was actually another institution that allowed Mario Draghi to, one, make these claims and actually follow through, because the Federal Reserve had, not at this point, an unlimited dollar swap line with the ECB, and it facilitated the ECB to provide dollar loans to the banking system, to banks in its own jurisdiction, even though it does not issue dollars. So next slide, please. This begs the question, like, what happens when there's financial crises generalized in the rest of the world? Who bails out the rest of the world? The Federal Reserve did do that for the ECB and for several other central banks. But what happens when it's not the ECB, when it's other countries, whether it's the Reserve Bank of India or the Banco Central de Brazil, or Bank of Mexico, or Bank of Canada, et cetera, et cetera. As we all know, like basically monetary economics 101, that central banks act as lenders of last resort for their own domestic banking system. However, if there's a shortage of liquidity in another currency in the national credit markets that is threatening financial stability, the central bank's ability to act as an effective lender of last resorts depends on its capacity to provide liquidity in that currency that is in short supply. Now, if this currency is not the national currency, which it does not issue, it becomes a problem, and which is why the support of the ECB's actions by the Fed by providing a dollar swap line assume increasing importance. And so the constraints that have become extremely relevant for central banks is because of financial debt globalization, which has resulted in increased borrowing and lending outside the borders of the national currency in question. Next slide, please. This is just to show the currency in which of course in question, no surprises here, is the US dollar, because most trade in goods and financial services is invoiced globally in the USD. This graph is taken from the BIS bulletin issued a few days ago, which shows the US dollar liabilities on the balance sheets of non-US banks. Now, this becomes a financial stability concern, especially if you see that share booked outside in the second panel on our right. If you see that the share booked outside the United States in the yellow line, in non-US banks in countries which do not have swap lines is pretty high, and that's why it's a concern for financial stability globally, because if the central banks of those countries would have to depend on their own reserves, on the IMF, which is slow to respond, and there's a lot of reasons why countries may not want to approach the IMF, and on all these factors to stabilize their domestic financial systems, because they might have not only banks but other entities, other non-financial corporations do have liabilities in the US dollar that are invoiced in the US dollar. So basically the question that I'm asking is what determines, okay, before we get to that, so here I define international lender of last resort because only the issuer of the international reserve currency, which is the US dollar, has the ability to act as the international lender of last resort. Now, this is not only the Federal Reserve, it's also the Treasury Department of the federal government of the United States, because historically, through this relatively less known fund called the Exchange Stabilization Fund, it has in the past, until from about 19 30 something, which I can't remember at the moment, until 2002 has provided short-term dollar loans to foreign governments when they need it. So after 2002, it's not entirely clear to me why it stopped providing loans through the ESF. The ESF still exists. It's just not used for this purpose anymore. I personally couldn't find any justification as to why it's the case, but maybe it's different cases. And therefore, the mechanisms that the Federal Reserve has to provide to act as the international resort are its reciprocal currency arrangements, which were first established in 1962. And the Treasury Department, as I mentioned, has the Exchange Stabilization Fund at its disposal. Now, I basically did the painstaking job of, it's funny, I thought that given that swap lines have become such a hot topic at this point, sorry, next slide, please, have become such a hot topic at this point, I thought it'd be super easy. Oh, sorry, one more slide. I missed this. Yes, thank you. That they've become such a hot topic that the data for this would be relatively easy to find. I was mistaken, but I had to do the painstaking work of going through FOMC meeting reports from 1962 to present to document the number of swap agreements that the Federal Reserve has actually entered in with. And I can report happily, or happily, because I could do it, that between 1962 and 2020, the Fed, 32 countries received 674 swap agreements with the Fed. Now, again, the way I count them is, again, Euro countries are counted separately when I'm counting countries. And also the swap agreements are counted by like if they're expired and they're renewed again, I count that as a fresh swap agreement. And I do this because reading through the FOMC minute reports, it becomes clear that it's not always like a foregone conclusion that the swap line will necessarily be renewed. And oftentimes there's a change in the size of the swap line, there's a change in the duration, and all of these things which make them distinct agreements. And therefore I've counted them separately. So as I said, 674 swap agreements with 32 countries between 1960 and 2020. On our right panel, we find the loans that the exchange, the number of countries that at a time have had loans with the US, have received loans from the US Treasury, and you can see that it varies very much, and there's a large preponderance during the 1960s, again during the 1980s, which coincides with the Latin American crises in several Latin American countries, and then it drops off after 2002 because there have been no loans from the ESF after 2002. And so given the important role the US dollar has, next slide please, and the ability of the ILLR institutions to effectively bail out whomever they want to when it's needed, the question I explore in this paper is what terms which countries get access to the international lender of last resort institutions. Because as you might remember, or maybe we'll go back to it later, in slide 4, it is not only the countries that have traditionally received swap lines that also have a large amount of outstanding liabilities in US dollars. Yet, these are not the countries that are on the radar of any of the ILLR institutions to actually to receive assistance from the international lender of last resort institutions. So I explore which factors can help us explain which countries get access to these institutions. And I break them down to economic and political factors. Basically, I guess I should have mentioned this before. It's that I have a strong suspicion, which I actually confirmed in my paper, that a lot of this really has to do not with any technical determinants that are often that you can often find in the official justifications of why countries receive swap lines from the Fed and why they don't. And I will mention what's the official narrative, but in the literature, these are the factors that are usually considered, and this is the dominant explanation in the limited literature in economics, which is that if the US banking system has a high exposure to the economy of another country, that country is more likely to receive a swap line from the Fed or a loan from the US Treasury if it is important for trade for the United States. So the country share in US exports. That would be a potential explanatory factor. In imports as well. Sorry about that. What are its level of foreign exchange reserves, and what is its share of GDP in global GDP and inflation. Now, I include foreign exchange reserves and inflation because one of the most influential papers in this literature is that by Eisenman and Pastrica, and they identify that oftentimes if the central bank is managing, or like the economic policy, not just the central bank, is managing the economy well, then those countries are more likely to receive assistance from they were looking only at the Federal Reserve, from the Federal Reserve. Yes, because it's a moderately high level of foreign exchange reserves is considered a sign of good management of the balance of payments, and a moderately and low inflation is considered a good sign of inflation management by the central bank. I include political factors because in the international political economy literature, there is some indication that it's really not a technocratic decision, that it's very much a political decision. And this political decision can be tied to certain factors that I have identified from reading through the political economy literature on this. First is capital account openness. Now, I included this because Sahasrabudhe in 2019 very convincingly argued that looking at just the extension of swap lines between 2007 and 2009, that banking exposure cannot be the full story. A lot of factors such as if the policy mix of a country mirrors that or is close to that of the United States, then that is a country that's more likely to receive assistance. Because there's no technocratic reason why a certain amount of capital account openness is a sign of good or bad financial management, especially since the narrative about at least the policy circles, the consensus about that has shifted radically in the last about 10, 15 years. Then I look at UN General Assembly voting record. And again, I have not mentioned the data sources here, so please feel free to ask me what is this data and where I got it from. But I use UN General Assembly voting record, and I see basically the literature in political science calculates an ideal point, which is sort of a policy preference for a country. So I see how much the ideal point varies of a country from that of the US. Then I consider whether a country has a US trade agreement with the US. And the reason I consider this as a political factor is because actually the volume of the share of exports and the share of imports, or the share of trade of a country in total US trade, is really it's only weakly correlated with whether a country has the US trade agreement. And further, we know for a fact that, for instance, trade agreements with Mexico and Canada are very much of a highly political nature. So it can't only be considered as one of economic importance. Then I consider whether a country has a defense cooperation agreement with the US, like basically a military alliance of some sort. And I consider US unemployment. I consider this because you can imagine that it would be politically unpopular to be helping out other countries when the macroeconomic situation in the US is not exactly favorable. So I expect that, thank you, Andrew. So I expect that if unemployment is high in the US, that all of these institutions are going to be less likely to want to help out other countries. I also consider the party composition of the government. I consider whether the president is Republican or Democrat. So I use a binary variable to do this, which takes the value 1 if the president is a Republican, and similarly if the lower house, the Congress, that's what they called it, yes, if Congress is in Republican control or if the Senate is in Republican control. I basically estimate a panel logit model using quarterly data for a broad panel of developed and developing countries, where the dependent variable indicates whether a country has access to an ILLR institution for the period between 1980 and 2018. My results, I checked robustness. It's pretty much robust to estimating a probit model or a linear probability model. So it's not like specific to the choice of model, but again, we can talk about that later because I'm running out of time. Next slide, please. So it was unbelievably hard to figure out how to present my results, but I'm just giving you a summary. So once again, if you want to see the tables and you want to see my paper, I'm happy to share it, not hiding anything. It's just the easiest way to present my results. Okay, so when I consider my dependent variable is whether a country received a swap line from the Fed or not. I find consistent with the literature that a 1% increase in bank exposure increases the log odds of having a swap agreement with the Federal Reserve by 2.49. Similarly, if you have a higher export share, the log odds of receiving a swap line increases. Interestingly, an increase in the foreign exchange reserves is associated with the decline in log odds, which counters the hypothesis presented by Eisenman and Pastrica that more foreign exchange reserves is an indicator of good management of the balance of payments. But again, we can talk about that. And a higher share of GDP decreases the log odds of receiving a swap. I do have an explanation for that, but we can come back to it. Interestingly, I find a lot of my political variables are extremely important in explaining which countries received access to the swap lines. Higher capital account openness increases the log odds, and again, the magnitudes of all my coefficients are higher. And again, like, please ask me questions about it if you have any questions, if you have any doubts about what I'm presenting. Having a defense cooperation agreement with the US increases the log odds of having a swap agreement, a trade agreement. Interestingly, a 1% increase in US employment increases the log odds. And again, we can discuss it when if people have questions about it. And a Republican president and a Republican Senate lowers the log odds of having a Fed swap agreement by certain quantities. And so clearly it appears that the Republican Party, their representatives are less outward looking. So those are my results. Next slide, please. I also do it for ESF loans, and I do it for them together, but I haven't presented that here. Anyway, I do it for ESF loans, and in this case also, you find that there's a similar, the results are similar to what I got for Fed swap lines. That increase in banking exposure increases the likelihood, increase in GDP share lowers the likelihood of receiving a loan from the Exchange Stabilization Fund, and the presence of inflation and a potential reciprocation reduces the probability of receiving an ESF loan. Trade agreement increases the probability. I don't know why inflation is over here, but yeah. And a Republican president increases the log odds of having an ESF loan. Now, there are a few countries in the database basically which received assistance at one point of time and didn't at another point of time. And apart from like countries that became part of the European Union later, if I exclude them, I narrow it down to just 3 countries. Next slide, please. Which is South Korea, New Zealand, and Brazil. Now, I just think it's interesting because I think it can shine a light of like give us more insight as to what are the factors, like what changes and what really are the determinants if you compare the same countries that received it at one time and did not at another time. So if you look at the graphs here, this is just charting US bank exposure over time. And for South Korea, New Zealand, and Brazil, the blue bars denote a time where there was a currency crisis at the time, and theoretically they could have used a swap line from the Fed. And again, whether they approached the Fed, I can talk about that later, but they didn't receive it. And the light gray bar, which you may be able to see, is when they actually received a swap line. And for instance, if you look at South Korea, it's when they didn't receive a swap line and they would have needed it, the bank exposure was actually higher in South Korea as compared to when it did. Similarly, next slide, please. If you look at the trade share,
this is time.
Okay,
so
I will
wrap up very quickly, please.
Yes. I'm going to skip to the next slide. Basically, when we look at South Korea, the difference here is that this is the difference between the voting record of this country in the United Nations General Assembly and that of the US. You can see, if you look at South Korea, interestingly, you can see that where there's a declining tendency in the difference between, so that as South Korea's voting record in the United Nations General Assembly gets closer to that of the US, it does receive a swap line. Sastre also has a very interesting explanation. She argues that because South Korea assumed chairmanship of the G20, that was one of the reasons why it got a swap line in 2008 and 2020 and not earlier. But again, we can explore this later. This is very preliminary. This is literally completely still working on it, this part of it. So yeah, please, comments are welcome. Next slide.
Thank you very much. That's great.
Okay.
No, I'm gonna rigidly enforce the 20 minutes. So I'm gonna,
okay,
the audience is now wanting more.
Okay, sure.
They can ask you at the end.
Sure. Thank
So
you.
thank you very much, Devika. That was great. Thank you. So our next speaker is Davide Villani from Open University and Goldsmith College, London. And if you are ready, Davide?
Yes. Thank you,
Okay.
Andrew. Can you hear me well?
Yes.
All right, great. Okay, good afternoon, everyone. Good morning and good evening, depending where you are. So I'm going to present also part of my PhD research, and this paper has to do with analysis of a concept that is the concept of external financial dependency that was coined, that was developed originally by Rajan and Zingales in a famous paper named Financial Dependence and Growth that was published in the American Economic Review in 1998. What I'm going to do is basically a revision and assessment of the theoretical and empirical foundation of this measure. So first of all, just as a way of introducing the topic, the External Financial Dependency Index is basically calculated at the industry level, and it's meant to reflect, in the author's words, the amount of desired investment that cannot be financed through internal cash flows generated by the same business. This measure is backed by two very important assumptions that I'm going to test in my study. The two assumptions are that the EFD index is steady in time, and the second assumption is that the EFD index is steady across countries. That is, it doesn't change in time and across countries. This means that the original estimations that were realized for American firms during the 80s are supposed to be a good proxy for other countries and other periods values of external financial dependency. Now, why am I so interested in this paper? I'm so interested in this paper because it became very, very influential in the financial and economic literature. Nowadays, there are nearly 10,000 citations, and the EFD index has been employed in many studies. What is surprising, however, is that despite its influence, there is very little discussion about the theoretical foundations, the assumptions, and the empirical application of the index. Today, there are only few studies that try to reproduce the original values of the index, while most of the literature just employ the same values that were obtained in Rajan and Zingales in their original paper. So the objectives of my paper is, first of all, to revise the EFD index in light of the emergence, in light of the rise of corporate net lending in G7 countries in the last decades. What I want to show is that the assumption of stability in time and across countries do not hold. And in order to do that, what I do is to extend the original estimation of the External Financial Dependency Index to G7 countries between 1980 and 2015 in order to test the two assumptions. Second, what I do is to show that the External Financial Dependency Index should be considered a proxy of corporate net lending. How do I do that? Basically, what I do is to compare the two definitions, the definition of EFD index and corporate net lending, and show the correlation between these two measures. Now, before entering into my analysis, let's present more closely the EFD index. The EFD index is calculated as follows, again, quoting the original paper by Rajan and Zingales. The external financial dependence is the dependence on external finance that is defined as capital expenditure minus cash flow from operations divided by capital expenditure. And here on the slide, you can see the formula that is basically 1 minus cash flow, the ratio of cash flow over capital expenditure. As I mentioned at the beginning, this index, the original index by Rajan and Zingales, was estimated employing data for American listed firms during the 1980s. Again, what is also very important to clarify and to have in mind is that the External Financial Dependency Index is meant to reflect sectoral technological futures of each industry. Again, using Rajan and Zingale's word, we assume that there is a technological reason why some industries depend more on external finance than others. So this basically means that more traditional industries will rely less on external finance, while more technically advanced industries such as computers, equipment, goods, etc., will rely more on external finance, or at least this is the view of Rajan and Zingales. Again, let me stress the importance of the two assumptions of stability of the index in time and across countries. The specific technological characteristics that determine the index according to the original formulation are steady across countries and time. Here I put a quote from a work written by Egan et al. In 2016, which basically states that external financial dependence reflects technological characteristics of an industry that are relatively stable across space and time. And these kind of statements are very common in the literature that employs this measure. So now entering in the analysis of the theoretical foundations of the index and the assumption of the index, first of all, I want to highlight some problems, in my view, with the assumptions. And these problems, first of all, are theoretical. If we look at the formula of the External Financial Dependency Index, basically what we see is that in order for the index to be steady in time and across countries, the ratio of cash flow over investment in a certain industry has to be constant, okay? So this is the only way for this index not to vary. However, I argue this seems to me a limiting assumption, at least for two reasons. There are more, if you want, we can discuss them in detail, but at least for two very important reasons. That is, first of all, the technique of production are not the same across countries. That is, the way rice is produced in Italy is probably very different from the way rice is produced in India, for instance, or in other developing countries. Therefore, it's very unlikely, in my opinion, that the ratio of cash flow of rice production in Italy will be the same than rice production in India. So the ratio of cash flow over capital expenditure may well vary across countries. The second aspect that has to do with the fact that the ratio of cash flow over capital expenditure can also change within the same country. And here we can just consider some processes such as technical change, offshoring, and automation that are very likely to alter the ratio of cash flow over capital expenditure in a certain industry. At the same time, if these processes are not have not the same intensity in all industry, what we may have also is a change in the ranking of the most financially dependent industry. So basically, this is to say that there are theoretical reasons to believe that the ratio of cash flow over capital expenditure will not be the same, and therefore that the External Financial Dependency Index will not be stable. In addition to the theoretical aspects, I also provide an empirical analysis. To do so, what I do is to extend the calculation of the External Financial Dependency Index to G7 countries over 4 periods, the 80s, the 90s, the 2000s, and then 6 years from 2010 to 2015. And to the best of my knowledge, this is the first attempt to replicate the index to such a long period of time. Since I want to replicate the original calculation, the methodology that I used is, where possible, the same as Rajan and Zingales. What appears from this analysis is a very different situation from that depicted by Rajan and Zingales and the literature that employs the EFD index. The graph in this slide shows the evolution of the average values of the EFD index in every country and in every period analyzed. From this picture, there are at least two aspects that should be stressed. The first one is that most of the values are negative. This basically suggests that, on average, industries are virtually not dependent on external finance. This means that the cash flow is higher than capital expenditure. And the second aspect, which contradicts the original assumption by Rajan and Zingales, is that the FD index does not seem to be stable in time. So in order to provide a more sound proof of the fact that the index may change in time and across countries, I did the following. First of all, to test the validity of the assumption of stability of the FD index across countries, what I did is to estimate the correlation between the American values of the index with other countries' values of the index during the same period. If the assumption of stability of the index holds, what we expect is to find a coefficient of correlation that is statistically significant and that is very close to 1. Now, what you can see on the table on the left of this slide, the black one, is that results show that only in few periods and countries there is a significant relationship between the two series. Therefore, we cannot argue that the index is stable across countries. The second aspect has to do with the validity of the assumption of stability of the index in time within the same country. Similarly, we expect that the values of the index within the same country are highly correlated from one period to the other in case the index does not change in time. However, what we can see from the second table proposed in this slide is that only in few periods and countries there is a significant relationship between the two series. Therefore, what I argue is that the two assumptions of stability in time and across countries do not vary significantly. Therefore, what are we measuring if we are not measuring what originally Rajan and Zingales were measuring? Well, what I argue is that the EFD index is basically a measure of corporate net lending. In the last 2-3 decades, the corporate sector in developed countries has shifted from being a net borrower to being a net lender. Basically, net lending or net borrowing is defined as the capacity of a corporate sector to rely on internal funds to cover their capital expenditure. In this sense, corporate net lending is very similar to the EFD index. However, you can see it also from the formula that I proposed in this slide. Net lending is equal to savings minus capital expenditure, while the EFD index is equal to 1 minus the ratio of cash flow over capital expenditure. Therefore, they are very similar measure. The only relevant difference is the fact that one, corporate net lending, employs savings as measure of internal liquidity of the firm, while the EFD index employs cash flow as the measure of internal liquidity of the firm. However, the question is, how is it possible that two measures that are so similar depart from very, very different environment and from very different assumptions? In fact, as we stated, the EFD index is supposed to be steady, constant in time, while corporate net lending is a measure that is free to fluctuate, free to move across countries and within the same country in time, okay? So this obviously is a contradiction. Therefore, what I did is to see the similarity between these two measures. Since the only relevant difference is the measure of internal liquidity of the firm, we have savings versus capital expenditure, versus cash flow of the firm. What I did was to compare the two measures of savings versus the measure of cash flow. And basically the argument is that corporate net lending and the External Financial Dependency Index can be considered different measures as long as savings and cash flow differ. In order to perform this empirical analysis, I basically did two things. First of all, I compared the definition of savings employed in the calculation of net lending and the definition of cash flow, which is employed in the calculation of the External Financial Dependency Index. They are both composed mainly by net income, and this already gives you a suggestion of the fact that they might be very different. And I also basically compare them in their evolution, their correlation. And what it appears is that these two measures are very similar. The second
5 minutes left, sorry.
Sorry?
You have 5 minutes left. Sorry.
All right, great. The other step I took in order to compare the measure of corporate net lending and the External Financial Dependency Index is to create a new version of the External Financial Dependency Index, where the only difference is in the measure of internal cash flow that I employ. In this case, instead of cash flow, what I use is savings, corporate savings, as in the measure of corporate net lending. After I calculate this new External Financial Dependency Index, what I do is to calculate again the coefficient of correlation between the original EFD index and the new EFD index. And what appears is that the two series are highly correlated in all countries and periods. So this basically allows me to conclude that the External Financial Dependency Index, the EFD index, is just a measure of corporate net lending, which therefore can fluctuate in time and can vary across different countries. Of course, I can show more in detail this calculation. I have no time to do that, so I just approach to the conclusions. But if you have any doubt or any question in this sense, please just ask. So as a way of conclusion, we can argue that the EFD index cannot be considered a measure that reflects uniquely technological and invariable characteristics of the industry. That was the original formulation of Rajan and Zingales. I argue also that there are several theoretical reasons to believe that the ratio of cash flow over capital expenditure can vary. I mentioned the fact that there is different technological change in industry, and this can alter the ratio of cash flow over capital expenditure. This basically modifies the values of the External Financial Dependency Index. This is actually what happens among G7 countries between 1980 and 2015. The two assumptions of stability in time and in space of the EFD index find little or no empirical support. Therefore, I argue also that the EFD index can be considered a proxy of corporate net lending, which evolves in time and differs across countries. And finally, I believe that these findings should be considered by the literature that employs the EFD index, which usually just employs the values that were originally estimated by Rajan and Zingales, and should consider the fact that those values may not reflect the external financial dependence of industry in other decades and in other countries. Thank you.
Thank you very much, Davide. That's, again, another great paper. And if you're enjoying these, please ask questions of the speakers in the Q&A box. We have a few already. And also, if you're enjoying this and you want to support the AHE in its various ventures, including laying on this kind of conference or putting on a postgraduate training workshop that we do every year, please consider donating to the association. You can do that through the website, heticon.net. Or indeed join the association. We're very glad to have you. So we'll move to our third speaker now. Davide, if you could stop sharing your screen. And our third speaker will be Monika Meireles from UNAM, Mexico.
Okay. I start sharing my screen now.
Okay.
Are you seeing it?
Yes.
Okay, perfect. So Uh, Good morning, good afternoon, good evening. First of all, I would like to thank the organizers for such a great work of connecting us. And what I have prepared for today is a work in progress. And the title is Financial Regionalization, New Foreign Bankings and Trans-Latin Banks. The motivation, and I'm going to read because I feel much more comfortable reading in English than just speaking, just free speaking. So I think that the motivation is going to be clear in the introduction, but here it is, a very summarized way to present it. The research aims to analyze the changes that have been taking place in the landscape of banking sector in Latin America nowadays. No, so I am most concerned about the origin of capital, to analyze the tendencies of the profitability in the banking sector, in this mainly in these new financial actors as the trans-Latin banks. And the hypothesis is that this reactivation of cross-border or activation of cross-border financial flows through South capital make us to think once again about what implies foreign credit channels and how this new kind of foreign banks is somehow changing the banking activity in our region, and the necessity of new kind or new types of regulation for these regional banking capital flows, in a more stable for provide a more stable banking activity in and financing, an ideal financing environment to promote development. So I'm starting reading now. This is more or less, before that, this is more or less the outline of the paper. Is a work in progress, as I mentioned before. And we have three parts. The first part is much more theoretical and historical considerations of these changes in the banking sectors, and what kind of literature I'm reading in the sense to provide my theoretical and historical background of this transformation. And the second part, we're going to see some data, and it's at a macroeconomic level, but mainly in a micro level of the bankings. And finally, some thoughts on the regulatory challenges that we are seeing in the South-South financial flows. So, among the effects of the crisis of 2007-2010, new regulations have been put in place in the banking sector worldwide. These regulations are adopted, making emphasis on the successive measures issued from Basel III. And that means the increase in capital requirements for the big global banks, mostly American and European ones. Given these measures, the availability of loanable resource from those banks to emerging economies has suffered a significant decrease, and we understand that discouragement of the deepening of the financial and globalization in its traditional circuits has been accompanied by the simultaneous growth of the financial regionalization. It seems that this double trend has been hastened by the events of the beginning of 2020, given the signs of deglobalization that it's announced as a result of the pandemic triggered by the new coronavirus. In a word, the strengthening of the regionalization of the financial circuits that we are already observed may be even deeper, given the nature of the economic crisis issued by the Great Confinement. As mentioned, the relatively low presence of resource from global banks destined to emerging economies has occurred concomitantly with the phenomenon that we see in the peripheral countries of a significantly increased presence of a new actor in the world bank systems. Foreign banks whose headquarters are in the same global south. In short, we are facing the emergence of a new circuit of cross-border financial flows that do not respond to the traditional logic of the 20th century, in which hegemonic centers emanated resources from their areas of influence. but we observe the existence of, at least in the financial field, new forces that constitute a sign of a multipolar finance of today financial geography. This is, of course, a slow, complex, and at times a turbulent transition towards an international monetary system with less dominance of the US dollar. We hope so. Furthermore, in these times, no one can anticipate with a satisfactory degree of a foresight what will be the real unfolding of the increasingly challenging position that Russia and China have been taking concerning Western hegemony, and even less about what it will be the definitive reconfiguration of the world geopolitics. Thus, the movement towards the regionalization of financial flows in time of hegemonic transition and the increasing importance of a multipolar finance can be mapped from the strengthening of the presence of unconventional foreign banks, here defined as banking houses that do not refer directly to American or European bankings. In the case of Latin America, we can be even more specific and emphasize that this threshold in the expansion of new foreign banks in the region is mainly characterized by A, trans-Latin banks, financial institutions from a Latin American country that expand their operations in other countries from the subcontinent, for example, the Brazilian Banco Itaú that we are going to analyze in a minute, and B, Chinese bank, whose presence has been growing significantly, such as the successive purchase of local banks by the Industrial and Commercial Bank of China. Our objective in this paper is to understand the trends towards regionalization of the flow of cross-border bank capital in the first of the aforementioned variants, arguing that the growing presence of trans-Latin banks compelled us to open a new line of conversation about the need for a more stable financial sector with a stronger regulatory architecture and grounded on regional institution for the supervision of banking activity. Thus, we analyze the changes that have been taking place in the scenes of the banking sectors in Latin America in recent years, highlighting A, the origin of capital, B, profitability, and C, the growing market power of the new credit actors. In summary, we seek to argue that after the 2007-2008 crisis, we are witnessing the reactivation of cross-border financial flows through South-South investment, a fact that does not imply other foreign credit channels to and from emerging economies, but also reinforces new patterns of foreign bank ownerships for host countries. I'm going to hurry up here in the theoretical and historical considerations to have time to show you some of the data that I already have. So, to understand the recent change in the bank sector is pertinent to describe them in a broader context of financial transformation in the framework of financialization, with emphasis of how this accumulation regime is presented with different idiosyncrasies in peripheral economies. Thus, we would like to address how is working the new banking arrangement for the economies of the global south after the financial crisis. And so we will use heterodox theoretical reference to understand the involvement of the banking from emerging countries in international financial integration with highlighting two aspects. One, the discussion on the deregulated finance of the Bretton Woods era and the rise of mega banks, and B, some thoughts on the role of banks in emerging economies in the international banking system and regional financial integration. The mega bank business model, and here we are using mostly the literature based on the work of Dimsky, analyze the changes in finances of the last decades. And this kind of post-Keynesian literature highlights how the source of, thanks to financial globalization, the source of instability increased and the possibilities for the state to regulate the mechanism that modulate the credit supply in its national territory became more difficult. And consequently, it has harder to manage the necessary policy instruments to limit the destructive potential of the deregulated finance and mitigate the negative economic effects of its inherent volatility. Thus, over time, the regulated finance has launched new challenges in the field of supervision, regulation of large banks, and governance, both nationally, regionally, internationally. It is worth mentioning that taken as a whole, these historical changes have not only been redrawing the distribution of power among the economic social agent of the world of finance, but are also actively changing the very configuration of the global financial geography. In this regard, DIMSC 2017 highlights how the financial crisis of the last decade have brought to the table, beyond questions about their origin, extent, and depth, aspects for thinking the special dimension of financial innovation and the new structures of the financial markets, where the role of mega banks and shadow banks in this territorial rearrangement stands out. Another extremely rich field of study in the post-Keynesian literature is the one that critically analyzes at a microeconomic level the changes in the way banks operate in this historical trajectory, highlighting how the way of conducting the mega bank business has been transformed substantially when compared to the traditional banks of the regulated financial era. At this level, the literature refers to how the current mega bank business model behaves. Put emphasis on A, the bank income depends more on commissions for the purchase of sales and securities, with a less relative weight of the income obtained by the conventional operations of credit granted. B, an important part of the profitability comes from shadow banking operations. C, the strengthening of its status as a bank systemic importance, its existence is guaranteed by public bailouts regardless of the risk of its operation, and even ensuring impunity for the criminal acts of the top management, the famous too big to fail, too big to jail. And D, less interchange of management information between the local and the central administration of large banks companies about the quality of the operations of the bank is executing. In the specific case of trans-Latin banks, we are not talking about the same way that mega banks with global presence operate, but it's important to note how certain trends also apply to the new large private bank with regional reach. Thus, we also observe that in the case of trans-Latin banks, there is a trend for a bank capital to increase, driven a wave of mergers in the region, especially due to the consolidation process in the sector with the incorporation of medium to large size conglomerate with performance beyond the borders of a single country in Latin America. Following the post-colonial literature, we can identify that the successive purchase of national banks by financial actors from other Latin American countries happens as a response to increased oligopolistic competition, with the expectation that the buying group can expand its participation in the market by absorbing the client portfolio from the incorporated bank. Oops. Oh, I'm sorry. Here, thinking about the regional financial integration, as we have mentioned, after the global financial crisis, this is a tendency. Financial in the regionalization has increased through the expansion of cross-border loans by foreign banks with a regional presence, especially banks outside the main world bank system. In the last 10 years, cross-border loans granted by banks in emerging economies have increased at a faster rate than those granted by banks in advanced economies, in such a way that regional financial integration between peripheral countries is increasing, especially led by the expansion of banking groups that have their parent company in emerging economies and that accelerate their intra-regional financial presence both through greater participation and the purchase of securities and by the acquisition of banks in other countries. In this context,
Monika,
emerging economies that. Okay. So I think I'm skip all this discussion and show you some of the figures that I've promised before. So here, to examine how the new actors operate in South-South financial regionalization, in this section we present some indicators of the behavior of the macroeconomic and microeconomic level of international banking. Figure 1. In figure 1, we can see the behavior of cross-border loans from banks in emerging economies to residents of other emerging economies, both in billions of dollars and as a percentage of total of international loans in the global banking system from 2014 to 2018. From the information provided there, we can find that the banking transactions between emerging economies have increased almost continually since 2014, when cross-border loans of this nature reached close to $1 billion, equivalent to 3.5% of the world total. In just 4 years, this value increased to $1.5 billion, $1.4 billion in 2008, which represents 5% of the total global loans for these years. The data includes credit provided by trans-Latin banks and Chinese banks, but also other financial institutions to the rest of the emerging economies, such as Pan-African banks. It is worth mentioning that also it represents a tiny part of the total cross-border bank lends. Operations between emerging economies have persistently become more visible over time. I think I'm going to skip the figure 2, and here it is. A concise example, Itaú Unibanco Holding Bank is the largest Brazilian bank by assets and is also the one with a strong presence in other countries in the region, such as Chile, Colombia, and Uruguay. Itaú is a clear example of trans-Latin bank since it is in a process of straightforward regionalization through, above all, purchase from medium-sized banks in other markets. In figure 3, we can see the continuous increase of the value of its assets, both in the national territory and in the operation of its branches abroad. However, we realize that simultaneously, here is in the black line, the total value of its assets. In the bars, however, we realize that simultaneously in the bars, Itaú's return on equity has decreased since 2004, from a maximum of 35% in 2004 to only 70% in 2019. Besides its return on equity shows a declining trajectory, it is slightly above the average return on equity of the Brazilian banking sector, which is 16.7% for 2017. And here is once again, the black line is the assets, but now for Itaú Corpobanca, which is the branch of Itaú in Chile, and the operation was completed in 2016, and how the assets of the operation of Itaú in Chile jumps up from 2016. Here I just brought some clipping to Itaú. This orange and blue logo is much more common now in the landscape of the banking sector in all the south part of Latin America. And I just brought it here to illustrate a little bit my argument. And finally, I'm going to jump to the final thoughts. The financial crisis the Great Financial Crisis redefined the discussions on the presence of state in finance, both through supervision and regulation of banking activity, in the debate of the whole of public banks. In an analysis of the functions of the states on this topic, Sihag and de Mercure 2013 argued that the public action can help to restore the trust of customers in the banking sector by means the faculties of its guarantee compliance in the segment, and also promoted the state ownership of the bank. Goodhart 2017, in a much more critical note, argues that regulatory failures in the banking sector are better addressed by governance reforms, rather than by simply increasing capital requirements and measures that affect bank liquidity, since the biggest flaw in regulation so far has been that banks were allowed to freely finance the acquisition of long maturing, ponderable, and therefore illiquid and risky assets that are hardly based on a short-term liabilities and without proportionally corresponding coverage. The current trend of increasing banking capital flows between emerging economies, the new business model of the banks, and the existence of a tendency to a multipolar finance are reshaping the landscape of the global banking sector. As we have seen, translating banks like Itaú have expanded their operation to other Latin American nations, giving rise to our variant of financial regionalization. It is known that this process is not as intense as what is currently happening in Africa with Pan-African banks led by internationalization of the banks of Togo, Morocco, and South Africa, and not as extensive as they're similarly observed in the Asia region. Furthermore, in Latin America, we also notice how Chinese banks have been seeking to increase their presence through cross-border loans and mergers and acquisition, which implies a more complex set of financial connections, because Chinese banks are following their clients, mainly Chinese companies that operate in agriculture or natural resource extraction sector. This pattern is making it difficult for Latin American countries to consolidate their path towards sustainable development. What is unequivocal in the fact that both trans-Latin banks and Chinese banks with a growing presence in Latin America are opening a new line of conversation on the need for regulation to have a more stable and truly complicity financial sector in finance, productivity, investment in host countries. I think I'm going to finish here because my time is over. Thank you very much for your attention.
Thank you very much, Monika. That was very interesting. Thanks a lot. And you could certainly comment on your last 2 points in the questioning, because I think the last couple of things that you had on your slides might link into some of the other conversation. I'll turn on my own video. We have just over 20 minutes for some questions, and there are some in the box. There's a couple have been answered, although I think there might be some time to go back to some of those. If we start with you, Devika, there were a couple of questions specifically for you, although feel free to answer any of them. How would you like to respond? So, for instance, there's a question from Jeff Powell about what explained the drop-off in swap agreements in the late 1990s. You're muted. Devika, you need to turn on your microphone. You're currently muted.
Sorry.
It's okay. Everyone does it. It's fine.
I was just saying there's a question before Jeff, so I'm just gonna get to that before.
Okay.
Question. So Akriti Mathur asked me if about standard goodness of fit tests for my preferred model, etc., and how well does my model work. So so the results that I presented were compiled. Like, I've run a lot of models, so all of my results, this is the result for one of them. So I haven't reported it in my paper yet. So the short answer is I don't remember, but I remember doing them, and that was why I preferred like my primary results to be a logit model as opposed to a probit model. But yeah, thanks for the reminder. I'll make sure that I include it in my papers so that I don't forget later. Short answer, it was okay, basically. Yes, so thank you for that. As far as what explained the drop-off in swap agreements in the late 90s, thank you so much for asking me that, because I do have a great explanation. So interestingly enough, there was a lot of swap agreements that existed since the 60s, which were usually bilateral to the extent that the Fed would also borrow from like draw on them. And these existed until 1998. What happened in 1995, because there was a huge crisis in Mexico, and the US government at the time, Bill Clinton's administration, wanted to make a huge loan to the Mexican government. However, what happened was that I believe Congress or Senate just didn't let that happen. So basically Bill Clinton, who has the president has a last authority over the ESF. Bill Clinton used the ESF to make a massive, unprecedented loan to the Mexican government of $20 billion, which really made a lot of people very upset and became like a real political problem. So when I was reading the FOMC meeting minutes, in 1998, all existing swap lines were terminated because of the political turmoil caused by the ESF loan that was made by Bill Clinton by bypassing democratic procedure and making that loan. So if there wasn't any like reason, the other reason was they hadn't been drawn on for like about a decade, since the 80s, that none of the central banks of the existing swap agreements that were there at the time were drawn upon. And so they were just terminated because it also became politically unpopular at the time. And this is very well documented in the FOMC meeting minutes, so which is also in my paper. And there's one more question for me. Should I just go ahead?
Let's give you a tiny break and give you a chance to think about that question. There's a couple of questions for Davide, and there's a question for Monika. So I don't know who wants to go first. Davide, you seem ready.
What? All right. Yes, I've seen a couple of them. The first one was about savings and as a cash flow or stock variables. I agree with Kriti, who made this question. It's true, savings may appear as a stock variable. However, as it is usually computed in the national accounts for the corporate sector, and also how is it usually computed in corporate net lending studies, is basically a flow variables, which is nearly equal to net income. It's basically net income plus depreciation and amortization. Therefore, they are flow variables. Some authors also discount dividend payments. I don't, but still, it's always flow variable. Then there is another one that has to do with how my findings challenge the use that is found in the literature, and which is very related to the third question, which is hold on a second, from Demetrios, if I have looked into how different EFD values may affect established papers and published papers. To answer to this last question, I do not know exactly. I mean, this is a pending work that can be done. However, I think that my critique is more on the theoretical foundation and the fact that the literature employs this index as a variable measure that grasp technical feature of the industry, which is not, or at least it is not, I argue, to the extent that it is usually believed. Another interesting aspect that may suggest that established results in the literature may be affected by my findings is that what appears is that industries are, at least if we employ the same measure employed by Rajan and Zingales, industries are not externally financial dependent. So this changes radically the interpretation of this index, because cash flow is simply enough to cover their capital expenditure. Therefore, at least virtually, the average firm in the industry does not require to go to the financial markets to borrow money. I mean, this is one finding that should be considered.
Okay, should we go to Monika? There's a couple of questions for Monika. We come back to you, Davide. Monika, there's a couple of questions for you. One from Antonella about relations between growing agricultural production in Latin America and the growing participation of Chinese banks. And another one below about too big to fail. as you mentioned, too big to jail.
Mm-hmm. Okay, thank you, Antonella, and thank you, Andres, for your questions. Concerning to the Antonella question, if I can speak a little bit more about the Chinese banks' presence in Latin America. The Chinese banks, and they are commercial banks, but a special kind of commercial bank because they are a political one, and the ownership of them are the Chinese republic. So it's a kind of a public commercial bank operating in another region. So inter-regional presence in the case of Latin America. And they are gradually changing the pattern of the credit granting in the region from lending for financing buying of of lending in Latin American countries to finance spends in infrastructure. So we are seeing the Chinese presence financing highways, the construction of highways, bridges, ports. But if we analyze a little bit closer this trend, we can see that we map, and in another work I'm working on that, mapping the concession of credits by Chinese bank, we can see that it's clear that it's reinforcing the roots that our traditional exports. So in some way, this new credit is financing a very old pattern of reprimarization of our exports. Another trying to answer what Andres asked me, and the case of Ecuador is it's notorious. It's a notorious case because we have the hermanos Isaías, the Isaías brothers that used to own a bank, and the last news that I know of the story that they are still in jail in Miami because they can put a foot in Ecuador anymore. And I would like to finish my comment, talking a little bit about another research that I'm doing about translating banks, because this is a problematic issue, because when you start to look deeper in the who are these guys, who are who are behind Itaú? Itaú Bank, this self-presented as Brazilian bank, more than a quarter of their stocks are in hands of BlackRock. So when we think about the regionalization of some Brazilian banks, actually we are seeing a old kind of external dependency once again, but with another mask, with another clause now. So this is problematic because it's not this is not a Brazilian banking spending, but BlackRock Capital finding other ways to guarantee that their regional presence. So thank you very much for your questions.
Thank you. I said I'd come back to you, Devika. There's a couple of questions that actually link quite well to what Monika was talking about. So, but how would you like to respond to the questions that other questions that you've had? So, for instance, there's a question from Andres about People's Republic of China swap lines policy and whether that looks like the US one. And there's another question about with swaps favouring the biggest central banks. So there's obviously a lot here about power asymmetries and various other things. So.
Yeah, I'll answer them together, in fact. So I did look at the swap. I was basically, in this whole process, I've apparently put together a list of all existing dollar swap agreements. So yeah, if anybody wants to see that, please email me. But I did like cursorily look at the PBOC swap agreements. The difference between the Bank of China swap agreements and the Fed, again, to what I understood, I have not looked at them with the same depth as I have the Federal Reserve swap agreements, is that they have a very clear, and I think documented, at least like there's no doubts about it, that they have a very clear motive to internationalize the renminbi. So that the purpose of a lot of the swap lines is to make sure that a lot of countries that don't have access to other forms of liquidity get access to renminbi liquidity, especially since there's a lot, I mean, there's also documented instances of central banks or governments using loans from China, either from the Central Bank of China or from the government of China or other state institutions, and actually selling them for dollars when they need it. But so it's like the only difference is that they have a very clear internationalizing motive, but like the Federal Reserve does not explicitly say so, that's sort of what they're saying. But again, I'm not sure that the PBOC says so, because I haven't really gone through I'm not even entirely certain if I can read the deliberations of the PBOC, which I could for the Fed. But yeah, I think it's a very similar criteria. It's just far more explicit. As far as the question, oh, thank you for that question, by the way. I think Karen's question is about SDR currencies. And so the thing is, I think here we need to define what we mean by biggest central banks. So it's true that all the SDR currencies, with the exception of the yen, so that would be the US, the euro, the pound, and the yen. So all these central banks have swap lines with the Fed. And in fact, all of them have unlimited swap lines with the Fed for an indefinite period of time, standing agreements. But like, I'm not sure what constitutes big, because big in terms of size of the economy, no. And big in terms of trade with the US, again, like that's not necessarily what constitutes big. Definitely big in terms of banking exposure, absolutely 100%, that is definitely the case. But I guess my interest is more, because these are also like natural political allies of the United States. And apart from like recent squabbles with Trump, a lot of the foreign policy objectives with respect to other countries have been very similarly aligned for a lot of the houses of big central banks. So yeah, I'm not sure if it's really just the major currency thing that's driving it, but rather something more, especially when we see who gets left out of the swap agreements. Yeah.
I've done it, you see. Thank you. Davide, do you want to comment on any of the questions to you?
I think there is one last question from Antonella I did not have the chance to answer, which is about the possibility of using the FD index like a proxy of corporate net lending. The short answer is yes. From my finding, what you can see is that you can use the EFD index as a proxy of corporate net lending. And basically the intuition is that the only difference between these two measures is in the proxy of internal liquidity of the firms that are employed. Cash flow versus savings. Now, let me just go back to the presentation very briefly. There are a couple of slides that I did not have the time to show. And here, basically, you can see the correlation between the evolution of the average cash flow by firms in this graph and the average savings by firms. So you can see that the two series are highly correlated. This brings me to say that they are basically the same thing. And similar, if you want a more statistically sound proof of what I'm saying, here what I show is the table of correlation between the two indexes. One that is the original index by Rajan and Zingales, at least the original formula by Rajan and Zingales, which employs cash flow, with the alternative measure of External Financial Dependency Index, which employs savings, which is the same as corporate net lending. As you can see from the table of correlation, the two measures are highly correlated. So this is why I conclude that that the EFD index can be considered a proxy of net lending.
Thank you. We've got about 5 minutes left. I think we've answered all the questions that are on there. I'm conscious that I stopped Devika from finishing. and actually she asked quite an interesting question on her last slide. So I think it might be useful just to you've got this question here about, here are your conclusions, which I think just summarize your findings, but you've also got this question about why does this matter? And you're asking now a question about stabilizing the global financial system. I thought that was worth coming back to, because certainly what Monika was talking about seemed to point towards the same sort of issues. So I wanted to give you a chance to answer your own question.
Okay, thank you so much. And I completely understand you having to cut me off. It's important that everyone gets the time to speak, but I'm also very grateful to come back to it. Why does this matter? I don't think that's important, because like, as I pointed out, and I showed you that there's a great threat to financial stability, given that central banks do not have the capacity to lend to their own domestic banking systems or other non-financial institutions in the US dollar. A lot of them have foreign exchange reserves, but they will run out eventually. And it won't even make a dent when they really have to step in and stop or backstop the system. And so this matters because the only institution that can do it is unwilling to do it. It brings us back to like the thing that the typical, he doesn't paint it as a dilemma, but what Kindleberger argued about the global monetary system way back when he's talking about the interwar era, he argues that at that time, the only central bank that had the ability to stabilize that at the time, the Bank of England was trying to stabilize the financial system, but given its declining importance and the declining importance of the pound sterling, it did not have the ability to do it. Thereafter, after World War II, it was given the change in the global monetary system, it was the primacy of the dollar. And therefore, since then, like really only the Federal Reserve has the capacity to do it. However, it's not willing to do so. And so the contradiction that arises is that there's a lot of discretion as to which countries the US wants to stabilize. And in this way, the US dollar becomes a vehicle for its own imperialism. But on top of that, it has greater implications for what we can imagine for a future monetary system, in which as long as it is an individual country's currency that remains the reserve currency of the entire world, there's always going to be this contradiction of whether the central bank of that country or the institutions of that country can actually prioritize, or even not even prioritize, whether they would actually care about the rest of the world if they have to if it becomes either economically unfeasible or politically unpopular within the country to help out the rest of the world. So it can't be based on this benevolence or discretion, which it at present is. And so that's why it matters. And I don't really have an alternative solution. I don't think SDRs are a solution because of a variety of reasons. That's a different discussion. But yeah, we have this basic contradiction in the international monetary system, which I don't think it gets talked about enough. So that was the answer to the question that I posed for myself. Thank you.
Okay, thank you very much. We are now basically at 5 o'clock. There was a question actually about whether the papers are available. I suppose that depends on whether the papers are finished papers and whether people are prepared to send them out or not. So I don't know whether you are. If you are, perhaps you could indicate, and then people could contact you. Or have you sent them to us? Have you sent them to us for posting on the? No. Okay.
I did. I don't know if it was uploaded. I mean, I didn't upload anything. I sent it to the organizers.
Yeah. Okay. So we have yours, but we have okay. So I suggest if anybody wants the papers, then they contact the authors directly. Thank you very much, speakers. Really good, really interesting, and some great connections between the papers. Thank you also, participants, some really good questions. It always enlivens the discussion. And thanks for coming to the session. Hopefully you'll join future ones of the AHE. There are a few more sessions left, including one or two tomorrow. So thank you very much.
Thank you.
Bye-bye.
Thank you. Bye.
Thank you. Bye.